Welcome to day 2 of our 30-day practical guide to building wealth through smart investing. Today, we're diving into the basics of investing, what it really means, how it differs from saving, and why understanding these foundations is crucial for your financial journey. Whether you're just starting out or looking to sharpen your skills, this lesson will help you see how investments create value and set you on the path to long-term wealth. Let's get started by exploring how your money can work for you, not just today, but for years to come. Imagine you've just received KSH 10,000. What would you do with it? Would you save it, spend it, or invest it? And why? These questions help us reflect on our financial habits and priorities. Maybe you tuck it away for a rainy day, or perhaps you'd look for ways to make it grow. Discussing these choices with others can reveal different perspectives and introduce you to new investment opportunities you might not have considered before. Let's use this as a starting point to understand the decisions investors face every day. On day 1, we learned that investing isn't just a one-time event. It's a journey built on knowledge, discipline, and patience. Today, we'll explore how investing works, how your money grows over time, and why starting early can make a significant difference. Understanding these concepts is essential before you evaluate any specific investment opportunities. By the end of this lesson, you'll have a clearer picture of how to make your money work for you and the importance of building a solid foundation. Start by distinguishing between saving and investing. Both are important for your financial future, but they serve different purposes. Saving is about setting money aside in a safe place for short-term goals or emergencies. Investing, on the other hand, is about using your money to buy assets that can grow in value or generate income over time. Understanding this difference is key to making smart financial decisions and building wealth. Saving means putting money aside in a secure place, like a bank account, for future use. It's usually for short-term goals or emergencies. Savings accounts, fixed deposits, and emergency funds are common examples. The main advantages are low risk and easy access to your money. However, the returns are modest, and inflation can reduce your money's purchasing power over time. Saving is essential for stability, but it's just one part of your financial plan. Investing involves using your money to purchase assets that can increase in value or generate income over time. Examples include stocks, bonds, mutual funds, real estate, and businesses. The main advantage is the potential for long-term growth and earning income through dividends, interest, or rent. However, investments come with risks, returns aren't guaranteed, and you need to understand what you're investing in. With research and discipline, investing can help you build wealth over time. Investments generate returns in several ways. The first is capital appreciation, when the value of your investment increases over time. For example, if you buy shares for KSH 100 each and later sell them for KSH 150, the increase is your capital gain. The second is income, such as dividends from shares, interest from bonds, or rental income from real estate. Finally, compounding allows your earnings to generate even more earnings when reinvested, accelerating your wealth growth. Capital appreciation happens when the value of an investment rises over time. For instance, you might purchase shares at a certain price and later sell them for a higher price. The difference is your profit, known as a capital gain. This is one of the main ways investments can help you grow your wealth. However, it's important to remember that values can also go down, so understanding the risks is essential. Some investments provide regular income. For example, certain company shares pay dividends, bonds pay interest, and real estate can generate rental income. These income streams can supplement your salary or provide financial stability in retirement. Choosing investments that align with your income needs and risk tolerance is an important part of building a balanced portfolio. Compounding is a powerful force in investing. When you reinvest your earnings, your future returns are calculated on both your original investment and the returns you've already earned. Over time, this snowball effect can significantly increase your wealth. The longer you invest, the more compounding works in your favor, making time one of your greatest allies as an investor. Time is one of the most valuable resources for investors. Starting early gives your investments more time to grow and benefit from compounding. For example, someone who begins investing at age 25 has a greater opportunity to accumulate wealth than someone who starts at 40, even if they invest the same amount. The earlier you start, the more you can take advantage of long-term growth. Inflation is the gradual increase in the prices of goods and services over time. As inflation rises, the same amount of money buys less, reducing your purchasing power. For example, if a loaf of bread costs KSH 60 today and inflation averages 5% annually, it will cost much more in the future. Investing can help offset inflation's effects, but it's important to remember that all investments carry some risk. Understanding asset classes is key to building a diversified investment portfolio. The main asset classes include stocks, bonds, mutual funds, exchange-traded funds (ETFs), and real estate. Each has its own benefits and risks. By learning about these options, you can make informed decisions that match your goals and risk tolerance. Stocks represent ownership in a company. When you buy shares, you become a part owner and may benefit from the company's growth and profits. Stocks offer the potential for long-term growth and, in some cases, dividends. However, stock prices can fluctuate significantly, so it's important to be comfortable with some ups and downs. Bonds are loans you make to governments or companies. In return, you receive regular interest payments and the return of your money at maturity. Bonds are generally less volatile than stocks and can provide steady income. However, their value can be affected by changes in interest rates and the creditworthiness of the issuer. Mutual funds pool money from many investors and are managed by professionals. This allows you to invest in a diversified portfolio without having to pick individual assets yourself. Mutual funds offer diversification and professional management, but they may charge management fees. It's important to understand these costs when choosing a fund. Exchange-traded funds, or ETFs, are funds that trade on stock exchanges like individual stocks. They offer diversification and often have lower costs than actively managed funds. However, their market prices can fluctuate throughout the trading day. ETFs are a flexible way to invest in a variety of assets with just one purchase. Real estate involves purchasing property with the expectation of earning rental income or benefiting from price appreciation. It can provide steady income and long-term value growth. However, real estate requires ongoing maintenance, may have market fluctuations, and is less liquid than many financial assets. Consider your goals and resources before investing in property. Diversification means spreading your investments across different assets instead of putting all your money in one place. This strategy helps reduce your exposure to any single investment and can smooth out your overall portfolio performance. While diversification doesn't guarantee profits or prevent losses, it's a widely used way to manage risk. New investors often make common mistakes, such as expecting immediate profits, investing without enough research, following rumors or social media hype, concentrating all their money in one investment, ignoring fees, or reacting emotionally to market changes. Developing a disciplined investment process and staying informed can help you avoid these pitfalls and make better decisions. Let's look at a real-life example. James received KSH 50,000. He had two options: keep all the money in cash for 5 years, or invest part of it in a diversified portfolio while maintaining an emergency fund. After 5 years, the diversified portfolio had the potential to outpace inflation, while cash alone lost purchasing power. This shows the importance of aligning your investments with your goals, time horizon, and risk tolerance. Now, let's put your knowledge into practice. Identify 3 investment opportunities available in your country. Compare their potential risks and rewards, and explain which one best suits a long-term investor and why. Discuss how diversification might improve a portfolio. This activity helps you apply what you've learned and think critically about real-world options. Let's discuss some important questions together. Why do people confuse saving with investing? How does inflation affect financial planning? Why is time important when investing? Which asset class interests you most, and why? How can investors balance growth opportunities with risk? These discussions deepen your understanding and help you learn from others' experiences. At the end of today's lesson, remember these key points. Saving and investing have different purposes. Investments can generate returns through growth, income, or both. Time and compounding are powerful contributors to long-term wealth. Inflation reduces purchasing power over time. Diversification helps manage investment risk. Every investment should be evaluated based on your financial goals and risk tolerance. Let's test your understanding with a quick quiz. What is the difference between saving and investing? Name 3 ways investments can generate returns. What is inflation? Why is diversification important? What is capital appreciation? Name 5 common asset classes. Why is starting early beneficial? Does diversification eliminate investment risk? Why should investors avoid making decisions based on rumors? How does compounding contribute to long-term growth? For the next lesson, research 3 investment products available in your country. For each product, identify how it works, its potential benefits, and its risks. Write a paragraph explaining the difference between saving and investing in your own words. Reflect on which asset class best aligns with your financial goals and why. This assignment will help you connect theory with real-world options. Today's lesson introduced the building blocks of investing. By understanding the difference between saving and investing, how investments create value, and the role of diversification and inflation, you've built a strong foundation for future lessons. Keep these principles in mind as you continue your investment journey. Next time, we'll explore financial markets, how buyers and sellers interact, the role of stock exchanges, and how market prices are determined. Understanding these concepts will help you make more informed investment decisions and navigate the world of finance with confidence. Investing is the process of using your money to buy assets that have the potential to grow in value or generate income over time. Unlike saving, which focuses on safety and liquidity, investing aims for growth and wealth creation. It's important to understand your goals and risk tolerance before choosing where to invest. Saving is about putting money aside in a secure place for future use, often for emergencies or short-term goals. Savings accounts and fixed deposits are typical examples. The main focus is on safety and easy access, but the returns are usually lower than investments. Saving is a key part of financial planning, especially for unexpected expenses. Investments can generate returns in two main ways: growth and income. Growth comes from capital appreciation, while income comes from dividends, interest, or rent. Some investments offer both. Understanding how your investments generate returns helps you choose the right mix for your goals. Every investment carries some level of risk. Stocks can rise or fall in value, bonds are affected by interest rates and credit risk, and real estate can fluctuate with the market. Understanding your risk tolerance and diversifying your investments can help you manage these risks and stay on track toward your goals. Savings are best for short-term needs and emergencies, while investing is suited for long-term goals like retirement or buying a home. The longer your time horizon, the more you can benefit from compounding and ride out market ups and downs. Matching your strategy to your goals is essential for success. Inflation slowly erodes the value of your money. If your savings don't keep up with rising prices, you lose purchasing power. Investing can help your money grow faster than inflation, but it's important to choose investments that match your risk tolerance and time frame. Stocks offer the potential for high returns and ownership in companies, but their prices can be volatile. They're best suited for investors who can tolerate ups and downs and are focused on long-term growth. Diversifying your stock holdings can help manage risk. Bonds are generally more stable than stocks and provide regular interest payments. They're a good choice for conservative investors or those seeking steady income. However, bonds can lose value if interest rates rise or if the issuer faces financial trouble. Mutual funds make it easy to diversify your investments. By pooling your money with others, you gain access to a wide range of assets managed by professionals. This reduces the risk of any single investment hurting your portfolio, but be mindful of management fees. ETFs combine the benefits of diversification with the flexibility of trading like stocks. They often have lower fees than mutual funds and can be bought or sold throughout the trading day. ETFs are a popular choice for investors seeking a simple, cost-effective way to build a portfolio. Real estate can provide rental income and long-term value growth, but it requires more involvement and has higher costs than many financial assets. It's less liquid, meaning it can take time to sell. Consider your resources and goals before investing in property. Imagine spreading your investments across stocks, bonds, mutual funds, ETFs, and real estate. If one asset performs poorly, others may do well, helping to balance your overall returns. Diversification is a key strategy for managing risk and achieving steady growth. It's easy to let emotions drive investment decisions, especially during market ups and downs. However, reacting emotionally can lead to poor choices, like selling at a loss or chasing trends. Developing a disciplined process and sticking to your plan helps you stay focused on your long-term goals. Before investing, take time to research your options. Understand how each investment works, its potential returns, and its risks. Avoid following rumors or social media hype. Informed decisions are the foundation of successful investing. Every investment should be evaluated based on your personal financial goals and risk tolerance. Whether you're saving for retirement, a home, or your child's education, choosing the right mix of assets helps you stay on track and achieve your objectives. Building wealth through investing is a journey that requires knowledge, discipline, and patience. By understanding the basics, saving versus investing, how returns are generated, the importance of time, inflation, and diversification, you're well on your way to making smart financial decisions. Keep learning and applying these principles as you move forward. In our next lesson, we'll dive deeper into financial markets, exploring how buyers and sellers interact, the the role of stock exchanges, and how market prices are determined. This knowledge will empower you to make even more informed investment choices. Stay tuned for more insights on your journey to financial success.